All right, so today is week 5. We're going to talk about share and bond valuation. Before I start with the share and bond valuation, let me talk a little bit about the assignments, as some of you have asked question about the assignment. For this clarification, we're going to actually talk about it a little bit. All right, so this is the instruction provided for assessment 2, and the instructions I'll show you how to do it. Okay. So this says here, go to the Yahoo Finance webpage. On the right-hand side, enter symbol and type the name of the company. These are all cool, nothing wrong. Look up, for example, Medibank this. Okay, I know these things. Click the historical prices, we know that. Okay. Set date range, this. Okay. February 2014. Okay. March, okay. And the end date 2016. Okay. Okay. This. All right. So from Yahoo Finance, we'll get. Okay. Load. We'll get the data. Keep only date and adjusted close. Similarly, collect the data for the same period for all ordinaries. This will be your market index. Okay. So we have to collect all orders as well. Okay. Convert the data from the oldest to newest using sort or filter. Follow the CAPM lecture note workshop 2 and divide the return using the formula given in page 1. Therefore, 2 sub-periods, risk-free monthly rate for interest rate. Okay. So these things will be fine. I think what your question is about, how do we get all this data, right? That's what is the problem, all ordinance. Okay, let me have a look. Let me show you guys how to do these things. So you go on Yahoo Finance. Yahoo Finance. Finance. Let's go. And let's say Medicare. Medicare. So you see a Medicare group. There you go. Now you can see Medicare group distance. So you have all this data is in here. You go to historical data.
But like, how do we choose Medicare at the end? How, like at the beginning, how do we choose the company?
Which company to choose, right?
Yeah. This. How do I know which company to choose?
All right. Okay. There is a list, I believe, name and code of listed Australian companies.
Okay, that's okay. I didn't click this link when I was looking at the assignment.
This is one of the things.
Okay.
For risk-free rate data for autumn 21 assignment. So this is risk-free data. You can see the risk-free data is also given here. The RF value is in here. Risk-free data is in here. So you can see it starts from June 69. You don't need just 69, okay? You will need from 2014 the state, right? So you go to, so like which date they gave us?
Yeah, I think it was 2014.
2016, 15, I think February they said, right? We're going to start from this data, February 14 to I think 16 something. So if you go in here, start the date range, select February 2014. Okay, till February 16. So you go in here, February 2014 to till February 2016. All right, so it's not that much. There we go. February. So this is the data. How many data is there? There are count 50 data is in there. So it's 25 months, isn't it? Yeah, 25 data set, I think. Yeah. 25 data set. All right, so you got the risk-free rate now, right? Now what we need? Market one, all ordinaries. So let's go to, so now we know, and format of the assignment, you can see the format as well. All right. Okay, so period one, March 14. Look, to calculate March 14, the return for March 14, you need to have data for February 14. All right, that's how they mean here. Okay, so you have to fill up this one. It's actually very plug and play, very easy. And now what else you need? All ORD. Yahoo Finance, so you got this, you got historical data. Now you select from here. You can see all your data is in month, so your start date is here. You got the start date as well. Not, you have to go to 14. So you go to 14 February, and you need the monthly data, not daily data. Monthly data, you can see it's monthly. And this is not this. February 2014. February, where you say 1st of February. And theory 2016 of February. That's the month data we have. Okay, so this is the data set. You can apply. Okay. So you got the data here. You have open, high, low, close, adjusted, close, and volume, right? Which data to keep? They already mentioned you which data to keep. So here is Medicare data. You don't need all of this data. Okay. All right, so they give me here date. Oh no, not date. Yeah. Okay, first of every month, the data is given here. Okay, so what things to keep? You don't need to keep all this data. You will need just to keep apply with this super period 2. So you understand now where to get the data from, right? How to collect the data. So you have to collect data for 2 periods. One period I just showed you here, do the same thing. And we need to keep on the date and the adjusted close. That's it, nothing else. So you keep the date. So these things all need to go. Delete. Volume, delete. That's it. Date, adjusted close. That's it. That's it. 25 data set. Okay. Got it now, guys? Any questions for me, guys, regarding this data? But no. And what else? And we need all odds. Okay. All ordinary. You see, you write AORD, all ordinaries. Let's see if we get all ordinary data. Yeah. Do exactly the same thing. February 14 to 2016, monthly, apply. And look, this data here is actually from, look, 16, see? It starts from 16 and going in down to 14. So you have to organize it all the same way, high to low. So here 14 to 16, you organize them same way. Okay, how do you organize them? It's from the filtering. If you go in home, you see here, home. So ascending order. Where is the ascending order? Let select this text. Actually, I'll show you from here. That will be better. Right, has been done. We can hit the download button.
Look at Emerson.
Options that are not available. Distributed data. But why I don't have this data as a download? Right. Why you don't have this data as download? Okay. You can check 25 data set, right? All ordinaries. Let me see. If it is not there, I think we'll have to get it manually. But the question is why it is like this. We have to get this figure. Just ordinary. But I really don't know why they don't have this download option here. It should be downloadable, all ord. Okay, so here is another link given. I think this is the list which has been given already. Let me see if we have the data is in here. Maybe we can download it by. So this is the data they have here too. It's exactly the same data, but my question is, so what, how do we get it? Open Excel sheet data, click from where, hard icon from the left, copy the URL. All right, open Excel, data, get data from the web, from web, Excel. Not from file, from database, no, from online services, from web. Get data from web. You have to close that link. Copy the URL. Hmm. Okay, there you go. See, if there is you get the data here. Yeah, just to close. Yeah. So I need these things from 2014. All right, I'll say load it. Load. It's getting data. That I will done. Okay. So I don't need this data here. I will set just to close. All right, let's see that the data is correctly loaded or not. You can see it from here. Okay, 28th of February, it is there. We have the data actually here. 5402, 5470. Let's have a look. Yeah, it's okay. This data has been loaded. So if I was in your case, to be honest, it's not that much of many of data, to be honest. It's just take February to 16. I don't need any of this. I would have deleted this out. I got my data, so I just need that just to explain. I don't need any of this. So you got the data here now. Now I want to actually here, I want to actually sort them out. Okay. Yeah, sorting. Down, right, up. What is my sorting actually? I think this is sorting. I think sorting is in here, filter. Here is sorting. Okay. I don't need the filter. Filter based on sort A to Z, a custom sort, for example, sort by date. Okay. Sort by date. The numbers text separately. Okay. So, oh wow, they did buy from these. Okay, I don't need that. Okay, I don't need that. What I need is this things needs to be actually. They came very bad way. I wanted these things to be in date format. Let's see if I can convert them into date format. General number sort date. Sort date. All right, it looks better now. So this is actually date format now. Okay. All right, now it's better. Again, looks like 2000. You know what I'm going to do actually is different. Have a look what I do now. It's not that easy, is it? I will copy this one. Custom sort by date, oldest to newest. Okay. This is the date set I have, right? So now let's go in here. Let me set newest to oldest. Now this is the date I have, right? So this data I'm going to set it up. That's the date I have. Actually, I'll show it in here and see if it matches. 2 February, January. Yeah, it matches perfectly actually. Yeah, it's okay. It's perfect. And yeah. I just changed the format. That's it. I will make these things. Okay. So go these things. Select it. Go for sorting. Sort oldest to newest. Okay. Choose sexy custom sorting I have to do. Sort by date. Yeah. Oldest to newest. Yes. Now I got the 2014 date. Okay. Yeah. Let me copy this date now, adjust it close. And now this is the way I'll change them to. Date. Not oldest to newest. Okay. We put it here. The other one that I just selected here. Copy. This is for. Oh, sorry. Okay. That's it. All out. Okay. And this one is RJ. Got it now? All out is your actually. All right. So you see now, you got it. And already RF is already given there as well. Where is RF? RF already given. Where is the Excel file? Risk-free data. That's for the RF. We don't need this all. I just need it from 2014. February 14. Till I need February 16 to do much on me. Okay. Copy that. There we go. That's your RF. Okay. So this is the one you have to find out. So RM is here, all odd, RF is here, and this is the one you have to find. All right. That's the way you work. Any question for me so far? I think I've done the half of your assignment already. Now you just do the type the formula and do those things. All right. So let's close it down. We don't have much time in here. Let me go back to my things. So format is already discussed. Assignment questions I showed you. Now, if you go to that file, the list of the companies, you can find which company you can take. I don't need that. Okay, this is fine. So file. So this is this automatic here. Anyway, so what else is in there? Name and code of the listed Australian companies. You have it here. Here is the companies here. You choose any of the companies you need. Okay. So code, here is the code. Here is the name of the company. And this is the thing. It's nice. So there are about thousands of them there. Choose anything you need. Okay. Any other questions for me, guys? Here is Medibank. NPR. Yeah. All right then. Let's write down code number. It's nothing serious. You can write down the company name as well, they will give you. But it's an idea that you can find out what company will be working on, what are the things involved in there. You can get those things. All right. Any other questions for me, guys?
All good.
All right, let's start with our bonds chapter for today. Okay. All right. And let's hide these things. So make it smaller. Okay. We're going to talk about bond valuation and share valuation. There's the two things we'll be discussing today: bond and share. Okay. Now, what are the difference between bond and share? That's a good term comes out. Share is issued by the private companies. They issue the share, and by issuing share, they will be collecting capital from the public for their business. One thing. Okay. Second thing is this like the other one. I mean, bond. Bond is issued by the government. Bond is issued by the government. And what happens in bond is this. They issue the bond to actually collect money from the public. Okay? They'll be issuing the bond to collect money from the public, and also for big project, they need some money, they will be actually issuing bond. And big companies also issues bond. Okay? So here we say valuation is also important. Okay. So yeah, bonds are issued by generally large corporations and government to raise large amount of money. When issued, bond usually have maturities greater than 1 year, 10 to 20 years in the quite common. They are contractual arrangement whereby the issuer agrees to pay the bondholder fixed interest payments, either yearly or more commonly semi-annually. Okay. So this is the fact that says here. The next they are okay, and if you go for how much mentions here, I'll show you. Okay, here it is. Very important, this line. In Australia, the conventions has been to call long-term loans. So in Australia, long-term loans to government bodies bond, while secured loans to companies have been called debentures. Very, don't get confused with all these terms, okay? Have a look. Government, okay, is called bond. large corporations. They also issue bond, okay? If it is secured, they call it debentures, okay? Debentures. Large, private large corporations, if it is unsecured, they call it unsecured notes. Unsecured notes. Okay, that's what they call it, unsecured notes. But for our purpose in here, look at here. So when we are working on for today, and unsecured loans to companies have been called unsecured notes. In recent times, now recently, there has been a tendency to adopt the US convention of also calling secured term loans to companies. Okay, so what they did now, this debenture also called as bonds like USA. All right, does it make sense now? Debenture in Australia is also called as bonds like USA. So in USA, they call it actually bond, large company. Australia, we call them debentures. But recently, we got the tendency of calling it as bond too. All clear, guys? So don't get confused with all those terminologies. What is debenture? What is this? Same thing. To simplify, we will generally call all long-term loans to government bodies and companies as bonds. So we'll take it as bond. We don't bring debentures in our case. All right? Everything will be considered as bonds. Now, bond valuations. How do you value the bond? A bond's value is the present value of payments the issuer is contractually obligated to make from the present until maturity. Okay? From the present until maturity. All right. So, future payments, namely the coupons and the principals, the face value are discounted by the rate required by the investors. This is also called the yield to maturity. How do they mean by these things? If these things are not clear to you, this chapter will not be clear to you. Okay? All right. Now, what is coupon rate? Now, let me give you an idea about how the bond works. Bond. Do they have a clear picture of any bond? Here, this is one is not bad. This is a bond. Okay. $5.14. This means 5.25%, repayable 15 November 1987. $20, transferable by delivery of $20. So $20 bond, how many years? Did they mention how many years? Issued under the Commonwealth Municipal Stock Act. Didn't mention treasury bond, okay. Treasury, Commonwealth of Australia treasury bond. But the question is for how many years? They did not mention that for how many years. Let's say this is long-term bond, for example. Okay. 10 years, 20 years, 50 years, doesn't matter. This 5.25% is called coupon rate. Okay, this is called coupon rate. $20 to be paid. This is called par value or face value. Okay. This is called par value or face value. That's what they mean here in this. All right, coupon rate, the principal. That principal is also the same thing. Principal, par value, face value, all of that $20. That's what it means here. Okay. Discounted by the rate required by the investors. We'll talk a little bit more about this one. Suppose a company is but not government. Let's say the company issue. Okay. And what did they say here? $1,000 coupon rate is 8.6% per annum. How much would you be willing to pay for the bond? The answer will be depending on what you require from the investment. Suppose you require 8% per annum. Okay, let's have a look what do they mean by these things. How does it work actually? The coupon interest, principal, present value. These things are coming up. So we need to actually clarify these things to you first. How are you going to work? Then I can go quick. You can understand it quickly. Have a look. I'm going to draw a timeline in here. Let's say here the bond starts. So I'm going to draw. Let's see if I can draw with hands. I'm drawing using hands. So this is the let's say timeline. This is timeline. Okay. So on this one, in this case in here, let's say you have paid in, let's say 2021. Let's say this is 21. Okay. And touch. This is 22, 23, 24. Like this. Okay. Timelines. This is the case.
Sir, is this for a bank bill or the bond?
You're discussing bond. What do you mean by bank bill?
Nothing. I might have understood something incorrectly. Sorry.
Okay. What do you mean bank bill? Actually, I'm not discussing bank bill here. I'm just talking here government and the large corporations issuing bond. Yes.
Yeah, sorry, my bad. Sorry.
It's all right. It's okay. Now, on 2021, you paid, let's say, $1,000. You paid $1,000. Gosh, let's see here. You paid $1,000. Okay. So this company coupon rate is, let's say, 8.6%. This $1,000 you paid. Okay, you paid $1,000. And the company or the government, they've given you a certificate like this for $1,000. And every year, after 1 year, every year is giving you interest. Okay, it's giving you interest in every year. Yeah. How much interest they're giving you? For 8.6%, $1,000, you get $86 interest you're getting. All right. You're getting $86. Okay, so every year you're getting 86. When you're getting this money, so look, this thing should be, I should put a minus sign in here because you're giving this money. Minus $1,000. Okay, and from 21, 22, 23, 24, every year you're getting this money. 86, 86, 86, you're getting this money. Last year, government is giving you 86. Okay, so they're giving you this 86. Okay, they're giving you 86 plus they're giving you that 1,000 you paid as an interest that will be also be returned. Okay. Okay, the last time they will give you this. All right, so that's the case we have. Okay, so they are the years. This is the case you have. So that's what they're trying to say here. Year one, how much you getting? 86. Year two, 86. Year three, 86. Every year getting 86. Last year, 10 years born. Last year getting 86 plus 1,000. Okay. Next. So how do we know? See, that's what I'm getting for from today to all the future value. I'm getting this. Now the problem is right on today, this year, for example, here, this is 2021. Okay, this is 2022. Okay, this is 2023. These years. All right. This is the thing you're getting here. In 86, you're getting it. Now the question is it true value of your money? On year one, beginning of year one, I think we should add up another one line here. Insert above. Okay, this should be at 0. Okay, at 0. Which year is that? Let's say 2020. Okay, at 0. You pay principal amount you paid minus 1,000. Okay. Or you can say the beginning of the year, like end of year. This is an end of year you're talking about. Okay, you pay $1,000. Now the question is, very good question. Question is, all this money in the future together will be equal value of this $1,000 or not today. Make sense what I'm saying? This $86 next year is not equivalent to 86 today, is it? Guys, you with me?
Yes, of course not. It's not.
So we have to calculate the present value of all this money we're getting in future on today's present value. Make sense?
Yeah.
Perfect. That's exactly what we have done here. We calculated the present value of these numbers. Look, 86 plus divided by this. This is divided. You look at here, it's divided. Okay? Divided by this using present value formula. So look, the $86 has a present value on today is 79. 86 in second year is 73, like this. If you add up all these numbers that you have in future until today, Altogether, the value of the figure is actually $1,040 today. Make sense? How much today, the value of all the money I'm going to get in future, okay, whatever I'm getting, the present value of all this money today is $1,040. Okay. That's it. If the value of today's my investment is how much? 1,000. If altogether money, all the money I'm getting in future, all present value of all this money I'm getting in future is more than $1,000, you go for the bond. Even it is 1,000 as well, yeah, it's same. Not profit, no loss. Your choice. Does it make sense to you all? So now the question comes up, then how do we calculate, what is the formula for these things? The formula is very simple. Valuation of bond is equal to this. Present value of first year, present value of second year, present value of third year, like this. How many years? It depends on that. So year one, interest, I is your interest, okay? And this value are there. Okay. This. Okay, so now it's all clear, right? All these values. The only thing here is funny. They have added the maturities. M is the principal amount into it. Okay, guys? All good with me?
Yep.
Done. That's the whole point. You understand the concept.
Yes.
Good. That's it. So now, interesting part is this. Look at here. Price of a bond is equal to present value of coupons. You know coupons what mean, right? Interest is the coupon, that coupon rate. We don't, in bond, we say we don't say interest rate or coupon rate. We don't say interest rate or interest. We say coupon rate or coupon money. Okay? The price of bond is equal to present value of coupons plus present value of principals. Yeah, present value of the, look at here, present value of all the coupons, you mean the interest, $86, the present value of $86. And finally, last year, $1,000. That's exactly is in here. All the interest is in here, plus last year's M, the capital, which they mean matured money. That's it. Now, we have made it a little bit simplified for you guys. According to our previous classes, we have said there is something called, if you pay the same amount on every year end, that becomes an annuity. Remember the annuity thought we talked about? That becomes an annuity. We're playing a trick in our formulas. Look, all this interest here, okay? All this interest here together is our same interest rate, annuities. So what we did, we applied the annuities formula here. Instead of doing it first year, second year, third year, fourth, we didn't do that. We did not do that. What we did, we applied the annuity formula. Annuities for interest plus present value for the principal money. That's it, done. See that? That's annuity formula here. RD, that's the interest rate. I mean the coupon rate for these bond issues. Okay, done. And number of years to maturity, M, par value or face value in dollar. So here you apply this, see how easy it is. Suppose M is this much, a coupon rate 8% per annum, interest rate paid annually, years to maturity and 20, RD is 0.08%, calculate the bond value at 1,000, done. Any questions for me, guys? Please. Any questions for me? No. All right, yield to maturity. What is YTM? Yield to maturity. Yield to maturity of a bond is the nominal interest rate that is the bond would earn if it were held to maturity. Okay, so how much money it would earn if it was kept as normal nominal interest rate. So look at here, in this case, like yield maturity would be this. 81, 2, 3, 1086, right? $860 you're gonna earn. That's the interest, right? $860 you're gonna earn in next 10 years. What is the interest rate? That's what they're talking about. Normal, simple. We're not talking about present value or those things here. Like if you calculate present value, you're earning just what is $1,040 present value. We're not talking about present value in this case. We're talking about $860 you're gonna earn in 10 years time as an interest. That's what they mean. You have the nominal interest, how much it will earn. Okay. If interest is paid annually, or the coupon is paid annually, the bond is selling at known price beta 0, for example, B0, bond 0. Yield to maturity is found by solving the bond valuation equation for RD. So what is the rate of interest? That's what we're going to calculate here. So yield to maturity will be, what is your rate of interest? Okay, how do you calculate that?
You mean I?
RD. You can say I. But for in here we don't want to confuse it with a normal interest rate. That's why we say RD. Yeah.
Isn't it we divide the yield by 200?
What do you mean by yield by 200?
To get the interest?
Yeah, we have to calculate this figure. We have to find out how do you calculate 0.0 this one. Like if you go in this formula, how do you calculate from this equation? How do you calculate RD? That's the question.
Oh, okay. Sorry. Yeah. Okay. Got it.
Okay.
Got it. Yeah.
All right. So they say with annual interest payments, YTM will obviously equal both the nominal and effective interest rate. If it is just for annual interest rate, it's normal. But if it is more than annual, if it's semi-annual or monthly rate, quarterly payment, then it's different. Remember when we talk about the more you pay, like in our previous classes, we said that but if you pay the interest more than once, effective interest rate is actually more than the nominal interest rate. That's what they mean. If it happens that is equal, we should all know that if it is annual payment is done, then effective interest rate will be equal to nominal interest. There's nothing serious in here. All right, now go here. Bonds are usually issued at a fixed interest rate payable on the face value of both the bond at the time of the issue of the bond. The coupon rate is the present value of the market interest rate. So coupon rate is the market interest rate. We've discussed nothing new here. Now here is the question comes up. If at any time at any point in time, age to maturity is greater than coupon rate, then bond value is less than par value. This says if yield to maturity. Now the question you may ask, what do you mean by yield to maturity and coupon? What is the difference between these two then? This RD is your coupon rate. So isn't it YTM is equal to coupon rate? No, it's not. Let's put it this way. You purchase the bond at year 2020. Okay. Now in 2025, you coming and discussing how much interest I'm getting. At this point, you're thinking now. After 5 years, you're thinking. Make sense? After 5 years, you're thinking, if I hold the bond for next 5 more years, what will my rate of interest actually? Okay. After 5 years, you're thinking about it. I want to see. Or let's say after 4th year, you said I want to close it up. I'm not waiting for till 10 years to get 1040. I'm not going there. I just want to stop it here. 4th year. How much interest did I earn? You know what I mean? That time it will not be 8.6%. It will be different. 8.6% was set on the basis of 10 years. After 4 years, you want to sell it. You don't want to wait till another 6 years to get that benefits. You said, no, I'm fine. I got better options, some other places, some other company giving me something better. I'm going to withdraw my money and invest somewhere else. Okay, so now the question comes up, what will be the rate of interest if you wait till it matures after 10 years? That's what is it. That's what it means here. Okay, so the main here, at any point in time, 3 years, 4 years, 5 years, if you see that if your yield to maturity is greater than coupon rate, so coupon rate, let's say 8.6%, but if you think, if I wait for another 5 years or 6 years, if I wait for the next 6 years, that will give me more, that is still more interest than the 8.6%. Then you understand that bond value is actually less than the par value. The bond is said to be selling at a discount. Okay, we're selling the bond at a lower price. Note, the bond will provide lower return, implies becoming unattractive. Therefore, the price of the bond will fall below the face value. Okay, YTM, if it is less than the coupon rate, the bond value is greater than the par value. Okay, so the value of the bond also increases, decreases. Okay, and if it is same, is same, nothing wrong in there. YTM will be decrease. That's a simple thing. All right. So there's nothing much in here. Okay. A key result is that the price of a bond and its yield to maturity vary inversely. The price of a bond and yield has a negative relationship. One is more, so they said an increase in the required return of bond will push down its price, leading to an increase in the YTM. Okay, and decrease it as opposite the way. I think there is nothing much in here. Okay, now I think we have one question, one solved solution in here. Okay, here this they show the inverse relationship. They're showing you here. Okay, the inverse relationship we try to show. For a bond with $1,000 par value and 8% coupon rate, we have the following graph. Is $1,000 is in here. We take up the bond, and what happens is that at one stage, like it will go up, it may go down. You can see here, bond price is 1,229.40. Okay. Slowly dropping. Okay. Slowly drops. It also happens like here, you can purchase something of $829. It will increase too. It will go high too. For YTM is 10%. Yields to maturity is 10%. So 8% is your coupon rate, but your YTM is 10%. Okay, it will go, it will increase. If your coupon rate is 8%, but YTM is 6%, less than the coupon rate, you see here, coupon rate is actually higher than the YTM, bond price will be dropping. Coupon rate is actually lower than the YTM into maturity rate, bond price will increase. That's the meaning. Okay. All right, some of the things, the reasons behind it is actually interest rate risk. It was like, look, 8.6% if your interest rate they're giving you, it is not fixed. Every year government is changing interest rate. You see that? We notice this. The government is changing interest rate every year. Okay, so interest rate is not fixed. That's why that when you are actually stuck with 8.6% coupon rate, but you see the market interest rate is different, that's the time your yield to maturity comes up. All right, so let's go on to the next. Consider a $1,000 par value bond with 8% coupon rate. So here is your bond price. YTM is actually 6%. Okay, YTM here is 8%, YTM here is 10%. So we have time maturity 10 years, time to maturity 10 years, time to maturity 20 years. The bond price are given in here. Okay, now what to do? This is a graphical presentation they try to show you. 20 years maturity and 10 years maturity. Okay, 8% in here, into maturity. Okay. This side is into maturity, this side is bond. So this is actually showing you 8%, YTM 8%, and this is, so it will be actually equivalent equilibrium at 8% interest rate. So what they mean here is that if YTM is equal to your coupon rate, okay, that's the bond price concept. Yeah, but when we also discussed these things in here, that here I'll show you. We also mentioned it in here. If YTM is a coupon rate, that bond value and par value is same. That's exactly the type to show here. When your bond value and this value is same, here your 8% is your bond value. Sorry, bond value is 1,000, 8% is your YTM, also your coupon rate. So yeah, it's the same thing to this thing. Okay, now the problem will arise if the bond paying interest more than once in a year. This goes more than once in a year. If the coupons are paid M times, so now again the same thing will come up. The formula will change. RD divided by M, RD divided by M to the power M. Exactly same thing, just multiply with M. Okay, here also the same thing, nothing else. Find the current value of the bond with a face value of $1,000, paying a semi-annual interest from an annual rate of 6.3% per annum, matching 20 years time with a coupon interest rate of 8% per annum. Okay. So here is the question comes up. M is given, M is given, M is given. Coupon interest rate is 8%, and required return is 6.3%. Okay, and interest is 8% of $1,080. And the formula plug and play, you get the answer. Okay, nothing more. I don't think we have anything much in here. Yeah, that's it. We don't have much in here. Now let's talk about share valuation techniques. So in bond, what we are doing, we are just doing annuities plus the present value of the par value. That's all. Yeah, share valuation. Preference share can be treated as much the same way as bond. Okay, what is efficient market hypothesis? Very important to understand this. For the efficient market hypothesis, it says that efficient market hypothesis. Look, in share, what happens is this. Very interesting. Let's say one share is being sold at $10, for example. One share in market, the share is being sold at $10, for example. Okay. Now you made a valuation of the share. You made a valuation of the share. You after making the valuation, you found, oh no, this share market value is actually $12. Make sense? The value of the share is $12, but the market price is actually $10. Make sense what I'm saying? Will you buy the share or not? Will you buy the share or not?
Yeah.
Of course. You got a ring, a diamond ring you found. Value of the ring is, you check the value is actually $10,000. But in the market, the shopkeeper is saying $4,000. You checked it, oh my God, this market value is too high. Sorry, the value is too high, but the market price is so low. Definitely gonna go and buy it. Same for share and bond. When you see that market value, sorry, value of the item is higher, sold at a lower price, you buy it. If you have a share, you check the market price. Okay, you check the market price is $12. You want to sell it now? People say, I'm going to give you $12. But you check the market, you check the value, share price by any chance, you found that the value is actually $8. Someone wants to give you $12 right now. What are you going to do? Sell it immediately. So this is the gap we have between the market price and the valuation. Make sense? That's not the problem. Now, efficient market hypothesis saying is this. If market is efficient, we never have this problem. I agree. I completely agree. If market is efficient, we don't have this problem. But market is not efficient. It says that all information about the company is being reflected through a share price. That's what it says. The efficient market hypothesis suggests that security price and share price, they mean, adjust quickly to reflect new information resulting in the market for a particular financial asset, which means the share, particular share, always being in equilibrium. A financial market is said to be efficient if all financial assets or share prices continually reflect all available information. So this means here, anything happens with the company, share price immediately have an impact. Normally it does not. I gave a phone call to Bunnings the other day. And I asked them a question, how your share price has gone up today? I said, yes. He said, but I went to the market and your customer service was really bad. How come your share price gone up? They're laughing at me. And they asked me, what do you do? I said, I'm doing a PhD research on the stock market. Now we are laughing, joking at each other. That's what happens. Anyway, my problem was sorted out. Okay. So yeah, it happens, it's normal. Okay, something goes wrong, but then reflect on the share price all the time. Okay, because market is not efficient. So we have three different types of markets we have. It's called weak form of market, semi-strong market, and strong market. Okay, weak form of market. Security prices reflect all information found, past prices and volume. Just very weak. We just have the information about the past. So Yahoo Finance you guys are looking at is actually past data, past stock market price only. Okay. Semi-strong, security price reflect all publicly available information, which means like just financial statement, annual report, all this data publicly available, those things are there. Strong, security price reflect all information public and private. Every information is there. Security market is giving all the information. Normally they don't. So this strong form of market is very rare. It's not there. Okay. This is the problem we have. And what we do, we actually calculate the price of a share now. This is called dividend discount dividend model, DDM we call it. Okay, discounted dividend model, we call this one, you can see. So the share price gives you dividend every year. You are getting dividend, you are getting dividends all the time. Okay. Generally, the value of share under uncertainty is given by this. Price of the share is dividends. Okay. All right, so we are actually trying to see that every year we are getting some dividends. What we're gonna do? We're gonna right now on today, like the bond, we're gonna check what are the future dividend we're gonna get in future. We are going to actually calculate back of these things to our present day. Okay, that's exactly what we're gonna do. That's what is the share price, how much dividend we get. But when you talk about expected return in here, we talk about dividend plus how much share price has gone up. That's what is the share price. Okay, that's the expected return. Interesting, isn't it? Nice. Says our required return on ordinary shares are now zero dividend growth. In this one, dividend is not growing. Hence, we can apply the present value of ordinary perpetuity in this case. So share price P equal to dividend 1 into all this interest rate. So D1 by R2. That's so simple. Constant dividend growth, dividend is growing at the constant rate. Okay, here, zero dividend. Dividend is not growing. All the time you're getting the same dividend. That's zero dividend growth. Okay. Dividend is not growing. Think about it. It's not like the dividend equal to 0. Dividend growth is not 0. Every time 10, 10, 10, 10, 10, 10, 10, 10, 10, all the time it's not growing. That's 0 growth dividend. Constant dividend growth, Gordon model, most commonly used, we say dividend is growing at 2%. Or 10% is growing. So first year, you get $10 as dividend. You invested $200 in a company to buy their share. First year, you're getting, let's say, $10 dividend. Next year, you're getting $12 dividend. The next year, you're getting, let's say, 14.4. Year after, let's say something more. So it's growing slowly. You see that? Slowly growing. This is called constant dividend growth. Dividend is growing constantly. Yeah. You see dividend equal to D0 plus 1 plus G. G is your growth rate. That's your growth rate. Constant growth rate. Okay, so that's the formula we have here. Infinite sum of geometric progression. So this is the formula we use. P0 equal to D1 divided by RS minus 2. The Gordon model we call this. Okay, so they gave an example in here as well. So these things are little bit easy and funny too, because D is given, R is given, P is given, calculation. So this is like plug and play, I will say this line. Like plug and play your auxiliary cable into your volume and you just start playing. That's it. Nothing serious in here. Variable dividend growth, interesting. Here, dividend growth is not constant. Like in this case, in this Gordon model here, let's say G is every year, dividend is growing by 2%. Dividend is growing by 2%. That is constant growth, all the time, 2 increasing. What happened last year? This year, 2% extra. What happened this year? Next year, 2% extra. Dividend growing all the time on 2%. And here, variable dividend. It's not 2% every year. Sometimes 2, sometimes 1, sometimes 3, sometimes 5, sometimes 0. It's like varying all the time. Okay. Initial growth rate of dividend is G up to the end of year N and not subsequent growth rate of G2. So you don't know. In this case, it's the, okay, so it becomes this. This is the model we have here. That is the present value of the first dividend payments plus the value of the share of beginning of the year N and discounted value of the. So it's like partially we have to go. Like let's from 0 to N, 1% of dividend, one growth, one type of growth, N to N1 different growth, N to N different. So we have to find out the growth rate of different time periods. Okay. Suppose R equals 0.07. Calculate P0 is 0. Okay, this is 0 dividend growth. An example they're giving it here. So let's say 0 dividend growth. This. And this one is constant dividend growth. Another example. And this one is variable dividend growth. One is 0, one is 4%, another one is 2%. Two different types. So the same thing. The G1 will be here. G1 is 4%. G2 is 2%. It's almost the same thing. Here that it will change 1 divided by 1 plus R. So next times dividend is like will be divided by 1 plus R to the power N. All right, we don't have much in there. All right, let's try with this problem set. This is from the last week, I think, the beta thing. Standard deviation, returns beta things, and I will do the CAPM thing we have to do from here. Okay. All right. The first one. Consider the following table that provides information, okay, on the standard deviation of returns and the beta of two shares A and B. Okay, beta of two shares A and B. All right, and then the beta corresponds to the B in the security market line of the CAPM, okay, so you know. So they're given us standard deviation, the beta. In answering the following question, reference to the above table, okay. Suppose the assumption CAPM satisfied. Which share A and B poses the greater total risk in respect to in terms? Any questions, guys? Which one? The standard deviation of return is 20%, B is 10%. Which one have a greater risk? A. Higher the standard deviation will tell you about the risk of the share. Okay. Here, look at the beta as well. Beta is also risky, 0.6 is your beta. Okay. Which share poses the greater systematic risk with respect to its return? Systematic risk, this is your systematic risk. So beta actually tells you the systematic risk, which you cannot avoid. Standard deviation tells you about the non-systematic diversifiable risk. Okay, non-systematic risk. Now, which a share A and B possesses the greater non-systematic diversifiable risk in respect to the return? Okay. Look, standard deviation, we'll write it down. Non-systematic. All right. Easy, easy. Okay. 20%, 60%. Which of them would have a higher risk premium? Give a reason for your answer. Which one will have a higher risk premium? Share B will have a higher risk premium because share B has a higher risk. Okay. So it has a higher systematic risk, so it will have a higher return. Why is that? From our CAPM model. What is our CAPM says? Our CAPM says that, okay, our CAPM says that, remember, if you remember the CAPM thing that I showed you in last week. If you remember that, we said RJ, so RJ is equal to this is the case, right? So this one is actually our and this is actually our this is actually our beta J. That's what they're talking here, right? This is the case. Look, this is your risk. Anybody is getting RF. Plus, the higher the beta will be, higher the market fixed premium will be. It's multiplying, that's why. Okay. Second one. Why do financial managers have some difficulty applying the CAPM in financial decision making? Generally, what benefits does the CAPM provide them? Okay. So CAPM provides financial managers with the link between the risk and return. Okay. So CAPM was developed to explain the behavior of securities, security price in efficient market using historical data. Okay. It may not give a future about it. CAPM may not give you information about the future. Okay. All right. So, but it gives them a view about the risk and return, relationship between risk and return. Okay. What else? These is also like used as the conceptual framework, the relationship between the risk and return. Nothing serious in there. Next one. According to the capital asset pricing model, the expected return on shares in the Gamma Corporation is 10.6%. The beta value associated with the share is 1.1, and the risk-free rate is 4%. Given the information, calculate the market risk premium and expected return on market portfolio. Very simple, very simple. Let's do it. That's the case we have, right? This is our formula. That's our formula. Okay. What we need to find out? First, we need to find out. Okay. RJ is given. How much is our RJ? 0.6%, right? 0.106. Okay. How much risk-free return? 4%. .04. Beta, they said already 1.1. RM, we don't know. Risk-free return, 0.04. Can you get the RM? Of course we can. What will be the RM? 0.06, which is equivalent to okay.
What? Sorry. What? How? Like, what's 0.06?
Yeah. I know where you're getting confused. I'm trying to fix it. Give me a second. All right. That's how I calculate. So RM is equal to this. Make sense now? It's even better now. So what is market risk premium?
It's RM minus RF, which is 0.06 minus 0.04. So 0.02, which is 2%.
Exactly. Yeah. Let's do the next one. An expected return, with asking the expected return on the market portfolio. Okay. How much it will be? The market portfolio will be market portfolio 6% plus 4%, 10%. That is market premium actually. Okay. Now let's go to the fourth one. So it says here, Suppose a share in CFM Incorporated is expected to be $50 in 3 years' time. The expected return on the market is 8% per annum. The risk-free rate is 5% per annum, and the beta of UWS Incorporated share is 1.75. Assuming the CAPM is valid and no dividend are expected to be paid over the 3 years, how much should you be willing to pay for the CAPM Incorporated share now? Again, same thing will come up. Okay, what is the RJ's value? Not this one here. I don't know that. So this one is equal to what? Is equal to 0.05 plus 1.75. Okay. Multiplied by 0.08. Okay. Minus 0.05. Okay. What will be the answer? Answer will be 0.1025, which is equivalent to 25%. Okay. How much you should be willing to pay for? You say here. Okay. P0 is equal to 50. 15 3 years time, right? $50. We are calculating the present values now, okay? That's what we're doing now, present values. 1 plus 0.1025, done. That's it. Equal to 37. Okay. The share price that's going to owe to $50 in future. So that's the future value divided by discounted rate. That's the present value. If now today present value is $37.31 and it grows by 10.25% every year, in next 3 years' time it's going to be $50. That's okay. If you pay less than $37 now to buy the share, you are winning. Okay, last one. Recurring return from asset J is this, or RJ given, RM given, RC. See, your assignment. Few things are given. What they want. From calculate the beta for asset J. After calculating the beta, provide the interpretation of that. What does the beta mean? How to calculate the beta here? Okay. All right. So we will have to take this table in Excel sheet. Okay. So it's RJ, RM, RF is there. So here we're going to calculate RJ minus RJ minus RF. We're going to calculate here RM minus RF. Okay. So this one will be equal to RJ minus RF. This one. this minus and this one will be equal to Rm, this minus Rf. Okay. This is our data. Okay. And even this two. This is the no. So this one is Rj minus Rf. Rf. This one is Rm minus Rf. That's it. You got it. Okay. Now, how do we calculate the correlations? We have to calculate for these two. We have to calculate our correlation coefficient on those things. Remember, last week I showed you how to calculate these things using data analysis. Okay, we have to calculate the correlation and the sigma values. That's how you will be able to calculate these figures. Now, for these two data, analysis, correlation, per columns, output range, correlation will be 97.6141. Let's say here, row. That's what we're gonna do. Okay. To 0.9761. Okay. Now we have to calculate standard deviation for this. Okay, this for RJ, this for RN. Summary. It's 1.4775. Okay. sigma 1.4776, for example. Okay. And here, and this much changes. Okay. The standard deviation is 1.6397. 1.6398. Okay, plug and play now. Let's calculate the beta values. Beta Jn is equal to, I don't know if you remember distance. This one multiplied by this one divided by equal to, you know it, easiest thing, 0.9761 multiplied by 1.4776 divided by 1.6398 equal to 0.8795. That's the answer. Okay, done. What does it mean? It means 1% increase in market return. Okay. So beta value, say here, this means 1% increase in market return, okay, will increase asset return, asset or share return, asset or share return by 0.8795. Okay, which is less than the market return. So, all right. Thank you very much for your time today, guys. Let's do our attendance. Okay, so my recent files. All right. Hamza, are you there? Hamza,
Yes.
yes. Okay. Haura. Nasser.
Yep.
Thank you very much. Tuan Dong. Zheng Yang Huang. Shui Lu.
Yes.
Thank you. Ishita Nambiar. Andy Nguyen. Latsami Odumsin.
Yeah.
Sami. Yes. Hugo Parsons.
Yep.
Yes. Hugo Edward Fong. John Trobus.
Yes.
Edward Fong was not there, sorry. Made a mistake. John Trobus.
Okay.
Thank you, John. Jiachi Wu.
I'm here.
Thank you, Jiachi Wu. Wanar Jang.
Yeah, I'm here.
Jili Ju.
You mean judge too?
No, Jili Ju. Then Chong Yu Wu. Jirui Ju.
Yes.
And who's next? Jiazi Ju.
Yes, I'm here.
Thank you. That's it. Thank you very much, guys. I'll see you guys on next week. Is our week? Do we have a workshop next week, week 6? I don't think so. All right.
I don't know about that, but
I don't think we have a class on next week.
okay.
If you go on the home page, if you notice in here on your, if you go on check on your learning guide. It must be mentioned in there. Okay, learning guide. With the learning guide, here it is. It should be mentioned in there. Where is the class? So if you go at the last page, not the last page actually. Here you go.
Will there be a recorded lecture in place?
I don't think so.
So it's just a free week off.
Week stops? No week this week. Easter Monday holiday.
Yeah.
Okay, so it's off. No class. You can see it here, 9/8. No class. Next week is off. You're gonna have time, good time for your assignment solutions. All right then, guys. I'll let you go.
See,
Enjoy your time and good night.
Thank you.
Yes, sir.
see you next week. I mean,
Next week.
class.
Sir, did you call a roll?
Yes.
Yeah.
Wait, I wasn't here just then. Sorry, I just came back and do something.
Okay, maybe not with me. Okay.
Oh, sorry, was that?
I don't know. I saw someone trying to talk to me, but I didn't know.
Sorry. I wanted to do something. I missed the roll.
What's your name?
Edward Fong.
What?
Edward Fong.
Why have you been, Edward Fong?
Where am I? Yeah, I'm here. Oh, sorry, I went to do something. I missed it. Yeah, thank you.
Okay.
Sorry about that, sir.
All right. I'll give you that. And the guys can see you've been attending all the classes. So yeah, you'll get it.
Yeah. Right.
Something
Sorry about that, sir. Well,
It's okay.
thank you, sir.
No worries. You have a good day.
Bye-bye.